A very good morning to all and welcome to our UOB FX Invest webinar. Thank you for joining us early today as we discuss the business landscape for SMEs. We are now 6 months into this COVID-19 pandemic, and our speakers today will share their views on how you can position your investments and FX holdings in this current economic climate. If you are welcome to send us any questions you have anytime during this webinar by using the chat box at the right side of the screen. During the presentation, polls will also run, so do participate in them and let us know your views. And now, we shall have Mr. Mervyn Koh to kick off today's webinar with an opening address. Mervyn is the Managing Director and Country Head of Business Banking within UOB's Group Retail. He has more than 18 years of experience in UOB, holding varied functions, including human resources and business banking. He oversees the SME portfolio, in particular the small business segment in Singapore, with both sales and product reporting into him. He has also been spearheading the digitalization of SME banking, in particular for small businesses through the co-creation of business operation solutions such as BizSmart, and also drive partnerships in the SME ecosystem. Mervyn, please.
Good morning, ladies and gentlemen. Welcome to this UOB FX webinar. The last time we had this webinar, it was about 4 to 5 months ago. I remember it was just before Singapore had our lockdown. Today, we are in phase 2 of our lockdown in Singapore. But still, we're not out of the woods yet. Any news that you read, that you come across these days, it's always about the fear of the second wave, or even like Hong Kong, talking about the third wave in itself. This is something which all governments fear of, and governments are running out of money to help companies, economies right through this crisis. If anything of a lockdown, governments cannot afford any form of national-wide lockdown, only sporadic domestic lockdown. If you look at Australia, Melbourne or Victoria is already facing a potential extended lockdown, and let alone going into New South Wales. On a global front, the US economy is still not out of its woods too. We're now facing reports of the second quarter in itself, and the numbers are not very promising. The Sino-US relationship is also much of a challenge these days. It's a tit-for-tat strategy. Consulates are being closed as we sort of read each day. So what does it mean for us going forward on a global scale? Domestically in Singapore, we are facing our second worst recession ever since independence. A lot of companies are still depending on the fortitude budgets given out by the government. So these are challenging times indeed. Today at UOB, we are here to work with our customers like you. I have 2 of my esteemed speakers today. I have Dharma, who is the Chief Investment Strategist of UOB Asset Management, who share with us in terms of investment strategies, things like equities or bonds, where do we put our monies into? And then I have Kun Hao, who is our Chief Economist, who talked to us about what are the roads ahead in terms of GDP growth, market recovery, etc. I hope you enjoyed this morning's session, and please make it interactive, fill in your questions, and we'll try our very best to get back to you as much as we can. Enjoy the session, and thank you.
Thank you, Mervyn. And now we'll have Kun Hao to brief us on some economic updates. Kun Hao has more than 2 decades of financial markets experience across various key asset classes, such as FX options, derivatives, and commodities. He has also actively participated in many investment seminars in the APAC region. Before joining UOB, Kun Hao was a senior FX strategist at a Swiss private bank, also covering the APAC region. So he's very familiar with how the economies around us will pan out during this crisis.
Thank you, and good morning, ladies and gentlemen. Good morning, Mervyn. Thank you for joining us today. As you heard from Mervyn, we're still in the middle of our fight against COVID-19. It is still a major challenge for Singapore, for every other country in the world. Now, for today, what I'm going to do is to share with everybody, the latest update in terms of, the macroeconomy across US and China, and of course, the implications to the US dollar as well as interest rates. Now, before I start, I thought we start the day, with a quote from Helen Keller. She said before, if you keep your face to the sunshine, you cannot see the shadows. And that's what sunflowers do. And I think that's very important and very appropriate for all of us, across Singapore, across Asia. Because if you focus, negative news regarding, every day, how many people die from COVID-19 and how the spread of the second, third wave is growing, you'll see a lot of shadows. And it can be mighty depressing. But if you focus on the sunshine, there are positives out there. There are opportunities out there that we can all take advantage of to ride through this crisis. Then, take this as a challenge. You can't choose the timing of COVID crisis, but it comes along. We make the best of it, as a business, as a nation, and then we move on to new things. So for today, my charts will show both sides. The shadows, which is the reality that everybody needs to be informed of, and of course, the sunshine, which, are things that are going right. And just to remind everybody, it's not all gloom and doom out there. So for a start, let's focus on the key question I get every time, which is, have we seen the worst in COVID-19 recession? And given that we're in Singapore, we're in Asia, I think we like to show, that contrast between how US and Chinese economy are performing right at the half-year mark. So first, let's talk about China. Now, all the charts that you see about China so far suggest that there's a very decent, very comforting, very nice rebound in all the macroeconomic and spending indicators. This chart is basically a chart of Chinese domestic travel, high-speed rail, domestic air travel. And you can see that it has a very nice rebound back from the lows, in February and March. And that was after Chinese cities reopened, in April. So as Mervyn alluded to, it is important for economies to stay open because you need domestic spending. And of course, this chart is for Chinese PMI, and you can see that there's a nice, very, very strong rebound back to even higher levels pre-COVID. So it looks like, what's happened in February and March, that sharp contraction is just a bad dream for China. So the question to ask is, have we seen the worst in the COVID-19 crisis for China? Has China come out of the woods? The second quarter GDP is a very encouraging positive 3.2% after the minus 6.8% contraction for China. Now, keep in mind these numbers because you're going to compare that against what's happening in the US later. So our forecast at UOB is this momentum is sustainable and that we'll see a very nice, possibly around 5% growth on average in the second half of the year for China. So if you add up the numbers, minus 6.8 for the first quarter, plus 3.2 for the second quarter, and around plus 5 for the second half, you'll end up with a positive number of about 1.8 to 2 for the whole year for China. So not a very big number. It is still a very small growth number compared to where we were at 6% growth last year, but it is still a positive number. And this is important because we're all in Asia. If China recovers and does well, it will send positive vibes and it will basically be positive for supply chain and trade across the region. Now, let's look at the US. This is a chart basically of US job market. And you can see basically that the hit to the US job market, given COVID-19. Now, what happened was in April, US lost about 20 million jobs. That's very significant. That's unprecedented. President Trump, of course, made a lot of note about the rebound, the 4 to 5 million rebound, subsequent rebound in jobs in May and June. But that's nothing compared to the 20 million job losses in April, which may take many more months or years to try to recover. Now you see the little circle in the middle of the chart that's labeled GFC. That's the number of job losses that we're seeing in the global financial crisis, in the Lehman crisis, in 0809. So just to show how different things are. This chart is a chart of unemployment rate in the US, and basically unemployment rate in the US is about 10%. And the broader measurement of unemployment, which what we call U6, underemployment rate, that includes the full unemployment, plus people who have moved from full-time to part-time job, plus people who have taken a hit in their earnings, plus people who have unfortunately lost their job and can't get back in the job market, that's around 18 to 20%. So just imagine in Singapore, if 1 in 5 of us are in one form or another jobless, that's got to be very, very severe and difficult, for the economy. So where does that leave us? At the end of the week, the US will issue their second quarter GDP numbers. We at UOB forecast a drop of as much as 35% on a seasonally adjusted basis after the minus 5.5% contraction in the first quarter. So minus 35 for the US in second quarter GDP. Remember the Chinese numbers. It was basically minus 6.8 in the first and plus 3.2 in the second. US is going to take a 1/3 hit in the economy basically in the second quarter. And that's how severe the situation is for the United States. So you can say China is first in, first out, and basically the United States is still in the midst of a severe recession amidst the fight for COVID-19 that appears to go the wrong way. Now, the IMF, of course, have updated their quarterly forecast, and basically you can see very clearly the IMF sees about a 5%, 4.9% unprecedented contraction in the world economy. Now, we at UOB basically believe that the year is difficult, of course, but going forward, a lot still needs to be done, to try to recover from this COVID-19 recession. So that's on the macro front. And the reason why I emphasize that contrast between US and China is to show that different parts of the world are tackling the COVID-19 crisis differently. China will do well if there is no major second or third wave outbreak. And of course, the United States still has a lot of work to be done. So where does that put the US dollar? And again, I think many of us will have heard this or read about this in recent days in the news, that the US dollar is about to collapse, that things are not going very well for the US. And of course, the US dollar may lose its reserve status, so on and so forth. This is an important chart. This chart has two lines on it, a red and a blue line. Now, the red line is the US dollar index, basically the trade-weighted value of the US dollar against major currencies like the euro and the sterling pound and the yen. The blue line is your interest rate support for the dollar index. So you can see where this is going. Over the past 10 years, you notice the blue line and the red line goes up together. Makes perfect sense because if there is more interest rate support, the US dollar will be stronger. So both lines go up together. Now, somewhere around middle of 2019, you notice the blue line starts to drop. This is where the US Federal Reserve started to cut interest rates to respond to the threats to the US economy from the US-China trade conflict. And around March this year, you see the blue line dropping all the way very significantly. That's where real interest rate starts to drop because the Fed cut their Fed fund rates, the nominal rates, all the way down to zero. So the US dollar is losing significant interest rate support. And of course, on that note, you will expect the red line to follow the blue line lower. The US dollar should rightfully trade lower. So our view at UOB is, yes, we would expect the US dollar to be weaker. That is true, and that's par for the course. But we do not subscribe to a disorderly collapse of the US dollar, simply because the US dollar, no matter what, is still the prime payment currency in the world. And of course, no matter what, the US dollar still makes up the bulk of global central bank reserve. Now, as far as you and I are concerned, when we have, when we do business with our friends outside of Singapore, most of it is still paid in US dollar. Trade is still done in US dollar. If you purchase commodities, whether it's food, whether it's energy and industrial metals, most of the commodities trade is still done in US dollar. So we cannot avoid the US dollar. And as such, while we see a drop in US dollar, we do not see a big collapse from here. So what does that mean for the rest of the key currencies? Well, the Aussie is a favorite amongst our region. I still remember the last time we met, Mervyn, we're talking about the Aussie. And of course, at that time, Aussie was still dropping and that fall has accelerated. Now, interestingly, of course, the Reserve Bank of Australia has cut all the way down to just 25 basis points, pretty much near the zero bound. And after they've done all their work, you find that the Aussie somehow has started to stabilize. There's one key differential. Remember what I said about interest rate differential that's moving against the US dollar. Now, in this case, basically interest rate differential have moved to the benefit of the Aussie dollar. Now, you can see on this chart, there's a light blue line and a dark blue line. Now, basically, the dark blue line is 10-year Australia government bond yield, and the light blue line is 10-year US Treasury yield. So you can see somewhere around 2017, when the Aussie started to fall, 80 cents to dollar, 70 cents to dollar, that was because the lines crossed the wrong way, meaning 10-year Australia pays lesser than 10-year US. Somewhere around March this year, the line crossed back the other way. So you find that 10-year Australia is now about 85 basis points, while 10-year US Treasuries, as we all know, is just under 60 basis points. So lo and behold, the Aussie started to recover and started to steady itself. So interest rate differential is a very important thing in the FX space. Now, where do we see Aussie? In fact, Aussie has already reached, our forecast, for the year and early next year. The important thing is our view is still that of a positive Aussie dollar. We will expect the Aussie to gradually trend higher, towards the low 70s against the dollar. And we would expect the Aussie, of course, to strengthen against the Sing back possibly towards parity, in the months ahead. One thing is important to take note. We all worry about the political, geopolitical crisis that's starting across the region. But the interesting thing to note is this. If you focus on the economic fundamentals, you will get the view correct. And what's the economic fundamental behind the Aussie? It is that China is stabilizing. As you saw before in my earlier charts, production activities are all growing and recovering. And that is why you see that in the background, despite all the political and geopolitical noise, China, in fact, has been buying more and more bulk commodities from Australia in the past few months. And that's contributed to the strength of the Aussie dollar. Moving on to China, as we're speaking about China, interestingly, again, I get this question a lot. Now, given the on and off and the escalating US-China tensions, why is the renminbi stable? Why is the renminbi even stronger? In fact, the renminbi is now back on the stronger side of 7 against the dollar. Back in March, it was around 7.15. Now we are back on the stronger side of 7, 6.99, around 7. And that's interesting, given that, as what Mervyn said earlier, we just had a tit-for-tat closure of consulates on both the US and China side. Again, I revert back to fundamentals. If you focus on the fundamentals, as you can see, Chinese economy is recovering first in, first out of COVID-19 recession, but the US economy, of course, is still in the middle, of a tough COVID fight and is still in a deep recession. So that is why renminbi shows up much more stable, much more stronger against the US dollar. And again, for us, we are in Singapore, we're in Asia, that's a very, very good thing. Right? If renminbi is stable and a bit stronger, that exudes confidence, and of course, that helps our regional currencies stabilize as well. And talking about regional currencies, what about the currency of our closest neighbor, Malaysia? Now, very simple terms, Malaysia is a key energy exporter. So if crude oil prices, if energy prices stay stable, does not go through that very painful dislocation that we saw back in April when WTI went down to negative, then the ringgit will be stable. On this chart, you can see two lines. The red line is, of course, Brent crude oil price, now back up to the mid-40s, holding within the $40 to $50 per barrel range. And the blue line is your inverted dollar ringgit exchange rate. So basically, the blue line, going up means, ringgit stabilizing. And you can see clearly that the blue line follows energy prices. If energy prices come down, ringgit will be weak. Energy prices go up, ringgit will be stronger and more stable. And right now, our view is that, energy prices should be relatively stable for now in the months ahead as OPEC do their best to basically lock in crude oil price around the $40 to $50 trading range. Now, this is important. They need to continue what we call their production discipline. They need to continue their compliance cuts. So if that's possible and Saudi Arabia, OPEC and Russia continue that cooperation, we will expect the ringgit to be stable around 4.25 to the dollar and just around 3 to the Singapore dollar. And finally, moving back to home, you remember the GDP charts for China and the US. And this is the GDP chart, the quarterly GDP chart for Singapore. And obviously, it portends a lot of shadow. It is not a very pleasant chart. Now, basically for the second quarter of this year, Singapore's economy contracted by 12.6% on a year-on-year basis and by 40% on a quarterly basis compared to the first quarter. So, you can hear in the background a heavy rain, and this is a sign of the difficult times that is going through for the Singapore economy right now. Just look at the chart. Second quarter GDP contraction is the worst so far compared to Asia financial crisis, SARS, and the GFC. So, our major pillars of our economy, whether it's mines, whether it's hospitality, whether it's F&B, whether it's tourism and construction, and of course, manufacturing are all under, key stress. And again, our view is this. Yes, it is a difficult second quarter. It will be a difficult year, but we believe that as the economy gradually reopens, gradually come back on track, and very important, as Chinese economy starts to gradually stabilize and recover, perhaps the second quarter contraction will be the worst that we have seen so far. Work, of course, remains, a lot of work remains ahead. And of course, we will need still to rely a lot on assistance from all the different packages, from the government. But if it all goes well, it is a difficult time, but perhaps the second quarter was the worst, and we can move on from there. And what's the key for the Singapore economy? Given our small population, is of course employment. And it's the same issue, even if you're a big or small economy, remember the unemployment chart for the United States. 10%, broader range around 20%, right? In Singapore, the official unemployment rate is around 2.5% now, and we see it climbing slowly higher towards 3.5%. Okay. Now, this is important because for Singapore, if you hear all the conversations, from all our ministers and of course, Senior Minister Taman, the prime objective of the government is to ensure that our SMEs, all of you, basically continue, stay alive to fight this COVID crisis, to write this off so that there is no mass layoff, so that unemployment rate doesn't rise too fast, too much. So we have the JSS scheme and all the schemes that are in place, and we believe that they will have a certain positive impact by limiting unemployment rate, to around 3.5% and not any higher. So let's hope this works, and this is the challenge for the Singapore economy to make sure, jobs stay intact. And finally, we talked about currency in this portion, and I'd like to round off this section with a quick look about the Singapore dollar. A question I get a lot this few days is, why is the Singapore dollar so strong? Dollar Sing is at 137, 138. Given the deep recession that we saw in the second quarter, should the Singapore dollar not trade at 145, right? This is too strong a level, on the stronger side of 140. Now, yes, the Singapore dollar is strong against the US dollar. And as I mentioned earlier, this is a function of US dollar weakness. But on a trade-weighted basis, you see on this chart, which is the vertical blue bars, you notice somewhere around the beginning of 2020, the blue bars have all been reset to neutral and a slight negative, bias. Now that's important because the MAS has already reset the Singapore dollar, the Sing Near, on a trade-weighted basis to a neutral zero appreciation path. This makes the currency a little bit more competitive, but it is pretty much recessionary setting. The last time we had this was during 08-09. So you can see, obviously, we are set at neutral on a trade-weighted basis. Now, what this means is this. If the US dollar continues to weaken, if renminbi continues to gain, if euro dollar, if Aussie continues to grow, to rally further, then obviously our currency, Singapore dollar, will follow these currencies higher on a trade-weighted basis, on a stronger level against the US dollar. So do not worry about Singapore dollar being too strong. On a trade-weighted basis, we are doing fine at neutral, moving on par with our regional currencies. Our forecast is that dollar Sing should stay anchored below 140 in the months ahead, and this is a recessionary setting for basically the Sing trade-weighted basis on a neutral level. So on that note, I'll pass the time now back to the compare, and we'll take a short break after this FX update.
Hi Joanne, I'm so sorry my meeting overran.
I knew that you could be running late. Don't worry, I've actually gone ahead to secure today's favorable FX rates based on your instructions.
Welcome back. Now Kun Hao will give us a quick update on the interest rates.
Okay, so let's proceed further. The next bit I want to discuss with everybody is about interest rates. And again, you notice that as the COVID-19 crisis dragged on, everybody gets a little bit more nervous, which is natural. The earlier discussion was about whether the US dollar will collapse, what's the direction. And of course, the other question, again, I get a lot lately is, what about interest rates? Will interest rates flatline at zero forever? Or basically, even will we go into negative rates, given how difficult and the strain the COVID-19 crisis is having a recessionary impact on all our economies? So before we talk about interest rates, I'm going to show everybody a few charts about what's happening in the background, and particularly what the US Federal Reserve has been doing. Now, this is a list of 9 emergency facilities. You call it 9, for the lack of a better word, 9 intervention bazookas that the Fed has fired to tackle the COVID-19 crisis. Now, since March, they have launched these 9 facilities, and they are huge, they are significant, they are unprecedented. Basically, all these 9 facilities intervene in every part of the fixed income and the money market. In the short end, you have the money market mutual fund, credit facilities, municipal facilities. The Fed, of course, is buying US treasuries, in large amount. And in the back end, you have this new corporate credit facility, both in the secondary and primary market. Now, what this means is that the US Federal Reserve is now buying straight into investment-grade corporate bonds by US corporates, either in the secondary market like you and me, or directly in the primary market when they are issued. The total amount is $750 billion US. That's how big it is. Now, the latest innovation is what we call the Main Street Loan Facility. Now, the Main Street Loan Facility is in fact, a very unique partnership between the Fed and the US government to loan directly to sectors in the economy that are troubled, to corporates who are in need, of basically funding and loans. So again, this is significant and about $600 billion US. Now, last night, the Fed made another important announcement. They basically said that all these facilities and more will now be extended from the original September deadline to the end of the year. 31st of December. So pretty much, we can be rest assured that the Fed is on top of everything to ensure that there's an orderly functioning of fixed income market, there's an orderly functioning of liquidity and cash flow across the economy. What all these 9 facilities do is that they want to prevent another cash crunch. Remember back in March and April, in the dark days of that market convulsion, when COVID-19 first hit the United States, we had a cash crunch. Those of us who wanted to borrow in US dollar, who needs access to US dollar, will probably have a bit of difficulty doing that. So it is good that the Fed is doing this all the way until the end of the year to give the US economy and the world enough time to recover from the COVID-19 crisis and to tackle this properly. So we have a longer runway. And as a result, you notice the Fed's balance sheet has jumped. It has jumped from $4 trillion to just around $7 trillion. This is $3 trillion of liquidity injection in just 3 months, April, May, June. Now, if you look at the other circles on the left-hand side of the chart, you can see how significant this intervention or this QE, this COVID-19 QE is. There's QE1, there's QE2, there's QE3. All this are around $1 trillion or slightly more, but across 1 year or more. Now we have $3 trillion in just 3 months. That's how significant that cash push is from the Fed. And that explains why the fixed income market, the equity market is doing so well now. And the net result is, of course, we see US money supply jumping, M1 and M2 jumping in excess of 1/4 and 1/3 compared to the year ago. To me, this is the most important chart for the day. Now, if you can take note of this, technically speaking, whenever an economy that has a money supply jumping by 1/3 or 1/4, what this means is that basically, it is printing money. This in very, very direct terms is what you would call helicopter money. And as a result, its currency should be weak. As a result, its interest rates should flatline near zero. And this is what we're seeing because, US dollar is indeed weaker. And of course, US interest rates are flatline near zero. For comparison, in China, the M1 and M2 will not go above 10%. That's the latest, understanding and hints from the Chinese authorities in the media. And of course, in Singapore, our money supply numbers are also just around 10%, slightly higher. So you can see how significant it is in the US. Interest rates, as we said, are flatline near zero. This is a chart of Fed fund futures all the way up to December end 2021. And you can see basically that the wiggly lines are all around zero. This is important because there were concerns earlier in the market, that the Fed may need to cut into negative, especially if everybody is forecasting a deep, 30% contraction in the US economy in the second quarter. The Fed has tackled this head on. Jerome Powell, Fed chair, and all the Fed officials have said point blank that they are not keen to experiment with negative interest rates because they've seen that, the previous experiments in Japan, in some parts of Europe over the past 5-6 years, leaves a lot to be desired. There is still a lot of uncertainty in terms of the efficacy, effectiveness of negative interest rates. And it is also clear that negative interest rates do more harm to the financial sector, to the banking sector in general. So the Fed has said point blank, they have much more tools in their toolkit to tackle this recession, and we believe in them. They have 9 intervention facilities extended to the end of the year, and if necessary, we hope not, I'm sure they'll do much more things like yield curve control, so on and so forth. So the view is that US interest rates will flatline near zero, but not basically go into negative. And of course, this is a chart on developed market interest rates. And again, you can see where this is going. Australia at 25 basis points, New Zealand at 25, Canada, and of course, the Bank of England is at 10 basis points. All the developed market central banks rates are stuck near zero. This is unfortunately the new normal. So what about Singapore? We talk a little bit about Singapore dollar. Remember, it is stable, neutral on a trade-weighted basis. but it appears strong against the US dollar because the US dollar is weak. Now, as for interest rates, you can see that our Singapore money market interest rates in the 3 months, the blue lines, which is SOR and SIBOR, follow the red line, which is 3-month US dollar LIBOR. So basically, as US interest rates flatline come down to towards zero, Singapore interest rates will come and stay down as well. This will probably be a repeat of the 2010 to 2015 period, where we have very, very low interest rates, where rates will stay near zero, just above zero for an extended period of time. But I want to emphasize this. This doesn't mean that, lending rates will come down to zero. This doesn't mean that rates will go negative, because unfortunately, we're in the middle of the deepest recession. And with a recession, credit risk will rise, credit costs will rise. In short, there will be more defaults, so on and so forth. And that basically means, you add it all up, rates will stay above zero. It will not come down towards zero. So you'll be forgiven to think that if that's the case, why should we worry about interest rates? And this is where I think we need to highlight, the shadow in the fixed income market. Now, in this case, basically, you can see this chart. This is a chart of US Treasuries, outstanding US Treasuries that are issued by the US government, by the Trump administration. You see this chart, there's a dark blue line, and the dark blue line has been growing, heading above the light blue line, which is US GDP, amount. And somewhere around the beginning of this year, the dark blue line took off and jumped significantly higher than the light blue line. Now, in short, the US is now forced by the COVID-19 crisis to issue more and more treasuries, to issue more and more debt. Right now, we have about 26.5 trillion US dollar worth of treasuries outstanding, way above the 21 trillion, US GDP amount. This is in excess of 1.1 times of the US GDP. Now, what this means is this: when the day comes when we have a vaccine for COVID-19, when the day comes, we really move into a recovery mode for the economy. Investors like all of us will start to ask, hey, look, how do we pay for all this debt that's been accumulated? This is a chart for the US. It's a bit extreme because Donald Trump will also need to pay for the tax cuts that he has enacted before the COVID-19 crisis. For the rest of our countries, it is pretty much a similar chart, but not on such an extreme level. Now, Japan, Malaysia, Singapore, all our fiscal deficits are near 20% of GDP. And of course, as I said earlier, when we do move into recovery mode, people will question about the pace of recovery because all this debt that's been accumulated needs to be paid. Now, what this means is there's now fiscal risk in the longer horizon. Longer term rates may not come down, may actually trend higher. So I just want to inject a note of caution that do not assume interest rates will stay low forever. The major amount of QE that we saw from the Fed, 3 trillion US dollar, the significant jump in money supply, 25% or 1/3, may even cause inflation years ahead. And of course, you have this fiscal risk. So rates may well move higher once the switch is turned the other way. So just take note and be wary of the narrative. Last chart from me, before I pass back to Dharma, is basically a chart on gold and interest rates. Now, we at UOB basically has the view that as long as interest rates stay low near zero in the front end, which is the case, gold should trade higher. And we've been positive on gold since last year. Now, the thing is this, gold has had a very, the pace of acceleration higher in gold has picked up very significantly. It is now there's a little bit of, semblance of speculation. But our view remains that gold will eventually trade higher. We are now at 1,950-ish, 60-ish US dollar per ounce. It's a foregone conclusion. We will trade above 2,000. Gold has really taken out the previous lifetime peak of about 1,920 back in 2011. So we are now in uncharted territory. That's that blue line that you see. So if you agree with us that interest rates will stay low, near zero, gold will continue to grind higher above 2,000, and slightly higher in the months ahead. Gold is a good portfolio diversifier risk. It's a slow and steady move. But take note, if you want to trade gold, be a bit cautious because in recent days, No, the intraday volatility is relatively high. There's a little bit more speculative element in this, shiny metal. So on that note, I'll end here and we'll pass the time back to Wen Tao. Thank you everybody for listening.
Welcome back, everyone. Next up, we have Damo, the Chief Investment Strategist of UOB AM Invest, to give us an outlook on the equity market. Damo has more than 20 years of investment industry experience. Prior to his current role, Damo was a senior member of the multi-asset strategy team, where he helped formulate the firm's asset allocation views and manage multi-asset portfolios for institutional clients. Before joining UOB AM, Damo was a senior investment analyst with Kim Eng Securities, where he was rated Best Singapore Analyst and Best Technology Analyst Asia x Japan by AQ Research in 2004.
Ladies and gentlemen, we have a lot of client queries as to when this COVID-19 pandemic will end. When will we get back to business as usual? Unfortunately, in these extraordinary times, basically, we think what we are experiencing is really the new normal. We won't be going back to business as usual. In fact, if anything, it's business unusual. We have also client queries that ask, what is the shape of the recovery? I think, how would market behave? Given that this current situation where economic data is so bad, why is market rallying so hard? Is there euphoria? Is there irrational exuberance in the market? Let me give you what our thoughts are. We believe that the recovery will actually not be N-shaped or U-shaped or W-shaped or L-shaped, but basically what we think the recovery will actually be a square root shape. And this is what happens in the market. Basically, when we had the COVID outbreak in February in China and then sort of spread to the rest of the world, we see markets sell off drastically when lockdown was imposed and economic activities almost grind to a standstill. Investors basically were uncertain what's going to happen, and because of that, markets simply sold off. But after that, what happened? Basically, what we saw was that government intervention in terms of subsidizing business costs, replacing lost personal income. Governments basically printed a lot of money and pumped a lot of liquidity into the system and did a lot of fiscal measures in terms of supporting the economy or supporting businesses and personal income. That basically gave confidence to market that we are actually going to get back to pre-COVID level. In this case, we basically mark pre-COVID level as point Z. And with that, basically, as market gained more and more confidence, market basically rebounded very hard. And where does it all end? It will actually stop where the point at the point in which that what is left between the endpoint Z and where market is simply the time value of money. That's basically how confident market is in terms of us recovering back to pre-COVID level. The blue line, I think, as we know that China retail sales tends to grow at approximately 8 to 10% every year. And the blue line basically shows the trend of what China retail sales should be had the COVID not happened. So basically what we've seen was that during the lockdown, retail sales collapsed and then basically stayed very low for a couple of months and started recovering as unlock started to happen in China. But basically, even after the rebound, basically today, retail sales is still about 11% below trend. And what we haven't seen is actually sort of a make-up of that, a catch-up of that lost sales that has happened in January and February. And what we've seen also is that the recovery or the rebound in retail activity is actually not even. It's actually uneven. In areas like food and beverage, we're actually, roughly speaking, around at trend growth level or slightly below that. Autos have actually rebounded above pre-COVID level. But basically, in terms of catering and clothes and more on the discretionary spending, it's actually still significantly below pre-COVID level. And in terms of other activities, I think as Kun Hao rightly just now mentioned, some parts of the economy has sort of recovered, some parts of the economy has actually rebounded. I think we see it in industrial value add or industrial activities, but basically in others, we are still seeing sort of sub-COVID level. And the thing is that what we've seen is that activity seems to have to start tapering off. On the left-hand side of the chart, what you see is actually subway ridership in China, and the three major cities in China, Beijing, Shanghai, and Guangzhou. What we've seen was that there was a collapse of that ridership in January and February because of the lockdown. Then gradually we saw that recovery, but sometime in June, actually what we see is that things start to plateau out, and they are actually still about 25% below pre-COVID level. I think in the right-hand side, we basically see sort of total passengers traveling in China is actually still about 45% below the pre-COVID level. So basically domestic travel, things like trains, high-speed rail or domestic airlines might see some recovery, but definitely on international travel, I think it's still not there yet. This chart on the left basically shows restaurants. And actually what we've seen is that restaurants have all reopened. The red line shows that most restaurants have actually reopened back to January 1st level. But in terms of restaurants billing, it is actually still 30% below below the pre-COVID level. So what is happening is that restaurants have opened, but actually because of the need for safe distancing, because of concerns by people in terms of going out, what we have seen is that restaurants is still doing less business than before. I think the most interesting chart in terms of looking at sort of business activity as a whole is actually the pollution chart that we see out of China. And basically what we've seen, again, is that the air pollution level has sort of have crept up as things begin to unlock. But after that, it actually starts to taper off, which basically suggests that business activity and economic activity has actually not recovered, and it's actually still about 10% below where it was pre-COVID level. I think this is because people are driving less, factories are probably not producing as much as before, so therefore pollution is actually a pretty good indicator of where economic activity is. This is a US chart in terms of COVID-19 infection. I don't have to repeat this, but basically what we've seen is that a second wave that started in June and now running at about 75,000 new cases a day. And because of that, what we've seen is that how it has affected sentiment and economic activity in the US as well. Basically, this is small business employee hours. We saw that recovery going into June, but after June, after the new cases started to climb, I think the impact on sentiment and people's willingness to go out and spend was actually affected, and business hours actually started to plateau sometime about mid-June. And this is not the only chart. Basically, if we look at other charts, it tells the same story. These are high-frequency data that's coming out, alternative data that's coming out. This is in terms of shopping mall foot traffic. Again, it sort of climbed and then plateau out sometime about mid-June. This is basically the restaurant bookings from the online booking website. Same picture, it started climbing and then plateau out in mid-June. So because of that, I think what we are concerned is that basically this square root market recovery that we expect has actually a wide spread of outcome. On a bullish case, we see that there is a possibility that market may actually rally harder and the slope will actually steepen if we have early discovery of vaccine or treatments and people actually start coming out and start spending again. On the other hand, if there is a big second wave causing widespread of business failures or causing sort of lockdowns again, then basically what we expect is that market may actually see a second leg down. So because of this widespread of possible outcome, we think market may actually be quite volatile going forward from here. The second point that I like to make is that healthcare sector is actually not the best vaccine play. We get clients query and says, hey, with this current situation, should we be investing in healthcare? After all, if there's vaccine, then healthcare stocks would run. We think that's actually not the case. And there's a few reasons for that. One is, of course, the healthcare industry. I think if you look at healthcare stock as an index, has actually recovered to its pre-COVID level. But what has happened is that actually we think the better play might be airlines, because airlines is actually still trading at 50% below its pre-COVID level. And the reason we said that is that for a lot of healthcare players, COVID is actually not a good thing. If anything, the beneficiary of the COVID-19 virus is actually very small, because there's only a very small group of companies that's working on vaccine, and we need to be able to, who is going to be the winner, who is going to come up with a vaccine first in order to benefit from it. And that's actually very difficult to do. For the rest of the healthcare sector, they actually don't benefit from it. Think about it. Hospitals basically suffer because a lot of non-essential procedures are actually pushed out, right? And drug trials for other kind of drugs that's not vaccine related is actually pushed out as well. So if you're a hospital or if you're a drug maker that's developing other type of drugs, things are actually worse off for you with the COVID-19. So basically, we think that the beneficiary are small, but actually a lot of healthcare sector players are actually suffering. So therefore, we think it is a long-term structural growth story. We have no question about that, meaning that if you want to invest in the healthcare sector for the long run, we are for it, but not for a short-term play on vaccine. And whereas for airlines, if you think of it, if there is a vaccine, then air travel will actually recover and airlines actually benefit from it. Obviously, there are some airlines that might not survive this whole episode, but for the better run airlines or the better capitalized airlines, definitely is something that you should think about as a way of playing that vaccine discovery. The other beneficiary we saw out of the vaccine, of the COVID-19, is basically glove makers. These are the pick and shovel suppliers in the gold rush. Basically, if you remember in the Californian gold rush, the people that made money are not the gold miners, but the people who sell the pick and shovels to these gold miners. And glove makers are in that category. So basically, we saw that glove makers' share price went up 4 times, 5 times year to date. And actually, that's very, very sharp rally. And I think we think that there's probably some room for cautious here. And we basically look at the precedent of surgical mask. If you remember, at the height of the crisis, probably about March, a box of surgical mask was going for about $50 per box, or about $1 per sheet. What is it? What price is it today? It's about more like $25, $23. Some people are telling me it's about $18. So basically, the surgical mask price has collapsed. And why has that been so? Basically, the high price of surgical masks attract new entrants because business is actually very reactive to price signals. When you have high prices and you have high margins, it tends to attract newcomers. And newcomers basically increase the supply of surgical masks, and that causes prices of surgical masks to come down. And we think that that's going to play out the same way in gloves as well. At current moment, we're still hearing glove makers talking about ASP increasing, but basically we think high ASP, high margin is going to attract new entrants and attract the competition that margin will actually gradually come back to normal. So we basically advise a bit of cautious in glove makers. The third point that I want to make is that it is not about the technology, but the application of technology. I think in this COVID crisis, what we've seen is that a lot of businesses actually innovate or had to innovate through digital means in order to continue their business. So, but basically, we are actually not promoting that you need to be the highest tech in order to succeed. Basically, if we look at the FANG stocks, and FANG actually stands for Facebook, Amazon, Apple, Netflix, and Google. Basically, if we look at these FANG stocks, which are actually the best performing stocks in the US market for the last 18 months, who among them is a technology company? If you look at it, Facebook is actually a media company, Amazon is a logistic company, Apple actually lags behind other phone makers in technology, Netflix is an entertainment company, and only Google probably qualifies as a technology company. So basically, it's not the technology that drives this company, but really it's the application of that technology to change their business model or to drive their business model that is actually driving this company. There is an MIT study that says 90% of CEOs believe that the digital economy will impact the industry, but less than 15% are executing on a digital strategy. So what we've seen during this crisis is that this boy band group called BTS actually managed to do an online concert that drew 756,000 audience and basically rakes in about $26 million. So before COVID, this is actually not possible. There is no venue that's big enough to hold 756,000 people. That is actually, roughly speaking, about 15 sports stadiums. But with the use of technology, with the use of video conferencing technology, they actually could do this concert. Right? So basically, this was the world's biggest paid online concert. So it's the opportunity to use technology to reach out to new opportunities in this COVID crisis. In China, there is this lady called Via Huang. She is crowned the queen of live stream commerce. Basically, if you know the Chinese environment, there is something called live stream commerce or 直播, that basically they were doing live streaming and at the same time selling things through this live streaming. And people could actually just buy what was being pitched with a click of a button under the screen. So this lady could actually sell a rocket launch for $40 million. She can really sell anything. And in one day, during the single day sales, November 11, she sold 3 billion RMB worth of products through live streaming. So basically, live streaming opened a new opportunity for businesses to reach out to clients. I think in Singapore, we have our own, if you remember, Ma Yuge Wang Lei, he is doing the same thing. So these are actually new opportunities through the use of technology to reach out to new businesses. And it's not just products that's being sold. In China, they actually sell funds as well. So you have actually fund managers pitch their ideas, tell their stories, and people can actually buy the funds immediately with the click of a button. In UOBAM, a bit of commercial here, we try to harness technology as well. We try to innovate through our digital transformation as well. We launched this Singapore first robo-advisor for corporate about more than a year ago. And this actually allows you to invest based on your risk profile and based on your investment horizon to create a customized portfolio for you. The algorithm actually allows you to time when you want to invest, when you want to make new injections, or when you want to withdraw some money for your for use, and at the end of the day gives you what your portfolio would look like at the end of your investment horizon, and basically what is your probability of success in terms of your portfolio, of your investment objective. So with that, basically, I want to leave you with two ideas. Basically, the first quote says that today it is not about the big eating the small, it's actually about the fast eating the slow. So think about it. It is how fast your company is moving. And the second quote says that when digital transformation is done right, it's like a caterpillar turning into a butterfly, but when it's done wrong, all you have is a really fast caterpillar. So I wish that all of you could take this opportunity to transform and become a butterfly. Thank you.
What is investing to you? At UOB Asset Management, we make sense of money. Now, let us help corporate investors to invest digitally with UOB AM Invest, Singapore's first digital advisory service for corporate investors. Using intelligent technology, we bring you access to the capabilities of one of the most awarded fund houses in the region with our top-rate investments. Let us partner you in this journey and support your corporate investment needs tomorrow. UOB AM Invest. We make sense of money.
Thank you, Damo and Kun Hao, for their very insightful sharing. So now we'll proceed to the fireside chat and the Q&A session. If you have any questions, do feel free to write them into a chat box at the right side of the screen.
All right, gentlemen, thank you this morning. I think it's very insightful and there's a lot of data to digest. And there's a lot of takeaways. But I think let's bring it down to what's happening domestically. Let's focus on Singapore. Given that you're facing one of the deepest recessions in sort of recent years, how do you see it playing out for Singapore? What should companies do? But before we come to that, there is a poll question that we ask our audience about recovery. Perhaps can we share with them the poll questions and take a minute or two to digest what the result shows us? Can we have the poll questions, please? So here it is. When does your company expect your business to start recovering to normal levels? You could see a good 70% takes from anything from 6 months to beyond 6 months. So based on these market sentiments, how do you see what should companies do going ahead? Perhaps start with Damo.
Well, basically, I think on a more positive side or more proactive side, we believe that companies should take this opportunity to basically transform themselves. As I mentioned just now, we think that there's a lot of, basically there's a need to try to recover because at this moment, what we have is that there is still the mood is actually still almost like a semi-lockdown kind of feeling. People still feel constrained. You can't go out that much, or you don't feel very comfortable going out. And if you go out, it's not you have to wear a face mask, which is not very comfortable. So I think basically businesses need to sort of reach out to them more proactively, reach out to their customers or their potential customers proactively, whether be it through online, whether be it through having delivery service rather than having client come to them. And I think these are some of the ways that companies really can do in terms of improving their business or trying to recover their business. And in fact, if they do that faster than their competitors, basically, this actually give them a chance to really get ahead of the industry.
Whole result pretty much, shows it that everybody expects the COVID crisis to basically drag on for the second half of the year. And I think it makes perfect sense because you hear this a lot, especially in the hospitality and the F&B sector, that as long as our borders stay semi-closed, right, tourism don't come in, and of course it's difficult for businesses to recover. Maybe I'll just share quickly a friend of mine in the F&B industry, what he's doing. Now the keyword is reinvent himself. He's from fine dining, so he's moved on, beaten the bullet to basically cook bento boxes. And obviously, he started to do delivery for bento boxes. And more importantly, he's made his waiters cooks to try to learn to cook. So the whole restaurant is now, a big kitchen and a big warehouse for him. And I think this is this is unfortunately the new normal. We just need to think out of the box, reinvent and retool ourselves, and make the best use, of all, the help, the governments and the authority can help us. So don't be afraid to think out of the box. Don't be afraid, to basically pick up, new processes and try to reinvent yourself. Easy for me to say because I'm not a business owner, but I think we do hear success cases in our conversations with everybody out there.
Yeah, indeed. What you mentioned is born out of necessity. But let's talk a bit about the next thing about the online strategy. I think, we've seen that this whole COVID shifts a lot of our consumption, my consumption, largely to online, whether it's shopping or food consumption. How should businesses embrace the online strategy going forward?
Maybe I'll just start first. I think, embrace it, hug it. That's the main thing. This is probably going to be a major way of doing businesses going forward. In fact, before COVID-19 started, you notice there's a slight shift away from the brick and mortar way of selling, right, to the more experiential kind of basically selling directly online. And shops are now just, to showcase key products. And this is what this is. COVID-19 has accelerated the process, to basically online and to the web. And if I can extend the argument, all our communication is now basically webinar online, right? And this is what it is. Imagine if COVID were to hit us 10 years ago. This may be a different proposition altogether. And for me, I would say this is a sunshine. This is a positive thing because technology is there. And as Mervyn used to say, needs are born out of necessity. So because technology is there, it's able to empower us. And now, we just need to do businesses in the safest and efficient way and make use of digital and online stuff.
Yeah, basically, I think interesting because I think I agree with Kun Hao about thinking out of the box. For example, sometimes one example I can see is that, for example, wine tasting. Last time you have wine tasting courses being conducted physically. Today, because we can't have that sort of physical congregation of people. Sorry, what I've seen is that wine tasting is now being sent to your home. So what you get is actually a box of 5 individual serving of wines, and then what you do is log in via Zoom, and actually the person conducting that wine tasting course actually goes, okay, let's start with the first wine, and then you sort of have that wine tasting session with a group of people while at home using sort of video conferencing. It's really, if you think of it, it's this sort of even very personal kind of service that used to be you require something that is in the physical presence has actually been delivered digitally. What I can think of is, for example, telemedicine is actually getting very big. And so basically businesses have to start thinking out of the box that even services that used to require physical presence are actually now delivered sort of online because we have, like, say, good video conferencing technology or good video technology that allows us to do that. So goods is almost very, very obvious. You need to have a sort of delivery online sales and delivery kind of model definitely in there.
One, it's to our customers who are in the SME business. It's how fast you sort of reinvent or redefine your business space. But I think from an investment angle, it's also good to study a bit deeper in terms of companies of what they are doing themselves to reinvent, and you can see whether it's worth picking up, or investing in that company from an equity standpoint. And that's right. All right, good. Let's move a bit more into the FX space. The US dollar, as you mentioned, Kunal, it's low. How do you see in terms of, a quick take on some currency pairings? We have some questions around that, but maybe give us a quick take on the RMB, the euro dollar.
So obviously, the US dollar is on the defensive. And if you want to sell the US dollar, the question to do is, what other currency pairs do you invest in? Now, traditionally, you would choose a currency pair that generates better return and yield. But unfortunately, all the developed market interest rates are flatline at zero. So you can't invest from that point of view. In our region, as you say, rightfully, we pick either euro, renminbi, or Aussie. Each has its advantage. Basically, for the Aussie, it is a proxy for growth. It is a proxy for recovery. If you're optimistic, you believe that things will really recover from here, China will stabilize, pick the Aussie. This still has that mileage. The renminbi is interesting because it may well be the high yield currency of the future. Think about it. Our Singapore 10-year government bond pays under 1%. The US Treasury in the 10-year pays 60 basis points. Chinese government in the 10-year pays 3%. So if you can invest efficiently, in an allocated manner in Chinese debt of good, decent credit quality, right? Perhaps that's the new normal. That's the new high yield. So that's that potential for renminbi. As for the euro, the eurozone more or less has got its act together with a new stimulus package, 700 billion euros, and that will help stabilize the euro as well. And it is still a top contender to sort of replace or fight a little bit the US dollar for reserve status and payment status. So perhaps if you want, you can invest a little bit in the euro as well. So each has its advantage in this new setup.
So maybe a question on FX as a basket for investment, Damo. How much percent? What's the percentage would you put into an FX basket as an investment holding?
Basically, to us, we tend to look at FX really, as Kunal mentioned, in the past we look at FX as a source of yield, but today when all the yields are so low around the world in terms of the developed market currencies, I think we really put very little in terms of FX. And I do agree with Kunhao that Chinese RMB may actually be the future, simply because that's, if you look at sort of China pushing its RMB to be an international currency, China sort of trying to sort of extending its reach and influence. So RMB may actually become more important as a reserve currency, especially for other developing markets going forward in future. So we are definitely bullish RMB in the longer term. In the short term, we think that sort of euro has a bit of momentum once it breaks 115. I think that's basically it's now about 117. I think there's a bit of momentum behind euro simply because euro has been depressed for so long due to concern of a sort of the existential concerns of the euro, whether euro will break up or the Euro Union will blow up. I think with sort of the rescue plan or the rescue fund, I think there's much less concern now, and I think there's a bit of more room for euro to actually strengthen. So definitely in the short term, we think euro, but in the long term, it's RMB.
So, with excess liquidity, we did have a poll question on this front. Let's see what the poll result shows on the excess liquidity. Yeah, give me the poll results for that. So, given sufficient levels of cash reserves for your company, what would you be most likely to invest in? A lot of them, interestingly, you could see the results. A lot of them hold cash, but it's also a lot moved into funds. Any thoughts around these results?
I'm encouraged that we have at least 26% looking into mutual funds and unit trusts. Basically, I think for coming from an investment side, definitely we're looking at sort of investing because FD currently sort of gives you very, very low yield, a very, very low interest rate. So it really depends on your risk appetite. If you have and also your investment horizon, obviously. If you have very low risk appetite and low and sort of short investment horizon, we think money market fund is a decent place to get a bit of a pickup. If your sort of investment horizon and sort of risk appetite is slightly better, we think short-term duration bond fund is the place to be. And basically, we always encourage people to buy a fund, not partially out of self-interest, but partially because we think that you need that diversification. Rather than buy a single bond, I think you should diversify with a bond fund. I think that's basically sort of in terms of if your investment horizon and risk appetite is sort of short and low risk appetite kind of situation. If you have sort of long-term money that you intend to invest, basically we think that the way to invest in is basically look for funds that sort of more future-proof, funds that look at sort of growth that has growth and innovative angle. That means, as Mervyn, you mentioned just now, companies that sort of are transforming themselves, companies that sort of are taking this opportunity to change their business model or to adapt to a new normal. I think those sort of investment themes will probably be the place to be.
Maybe if I can add on a thematic level, right? Focus on investments in our region, in ASEAN. All the studies have shown that, in fact, basically ASEAN is anchored by China. If China, as we say, stabilizes, that's good for us. And that because of, the changes in supply chain we've seen over the past 2-3 years, there's a lot of investments flowing into ASEAN, into Vietnam, so on and so forth. So we're in the right place in the world, and we should invest in our neighbors. So perhaps, focus a bit more on thematic themes in ASEAN and of course in Vietnam. And if I can add, on a last note, on a personal basis, if you have excess cash and liquidity, do go out and spend. Help our own businesses, right? Help spend with our own businesses, help our retail, help our restaurants, because that's the only way we can help each other out of this crisis.
I cannot agree. That, if you saw read recently, our Singapore government is trying to drive domestic tourism. I think it's a right stance, albeit, our sort of population is quite small compared to, say, Japan, but at least, it helps drive the local confidence, if you will. Now, there are a couple of questions you would like to take that sort of come in, and I think some of it has been answered, but I think what's interesting, it's, Richard has asked, is Singapore or the ASEAN market? In the Singapore ASEAN market, do you see more provisions needed to cater for losses, of which top 3 is a concern sector for you? Any thoughts on that?
So, as I said before, and I think this is not just Singapore. This is the same for Thailand, for most countries as well. Tourism is a key concern, right? The tourism sector used to be a how should I say, accepted growth market, but clearly with COVID-19, nobody flies anymore. Most international flights may not resume anytime this year. So I think tourism and its associated industry, F&B, hospitality, will find it tough. And I want to emphasize this is not just Singapore, but across the region.
Damo, anything to add to that?
Basically, I think what we are going through now is that we've actually been, I always say we're on painkillers. The government has basically provided a lot of subsidies and support. But I think going into Q3, Q4, that painkiller is going to be withdrawn. And I think that's when we really see how much pain we actually feel. I think that's definitely the sort of the fact of life, whether in Singapore or anywhere around the world. I think I agree with Kun Hao. Sort of the obvious ones are basically your tourisms and the related areas, whether MICE, whether just now I talked about even hospitals, basically, because medical tourism is no longer there, and sort of non-essential procedures are actually being postponed. So things like that, definitely those are some of the areas. But I can't, at this moment, I really can't think of anyone that's really specific. But definitely things like construction sector is probably another area that there is a bit of a concern, whether because of especially more like in our specific situation, in which that sort of the foreign workers cannot resume work, and I think those are probably causes of concerns for, say, the whole construction industry.
But we're sort of out of time. There are a lot of questions, but I want to thank everyone who so actively participated and fielded in your questions. I think there is a recording of this webinar, which we can post it on our online. But for you, customers of UOB, thank you for your support. And if any needs on your business, we have a team of specialists, not only from the treasury side, but also from the investment side. Do speak to your RM, do speak to any one of us. Meanwhile, stay safe, and I wish you all the best ahead. Thank you.